Good evening, everyone. I'd like to welcome you all to the Accounting and Tax for Medical Resident session. I'm Laura Lamb, and Jolene Cashin is presenting with me today. We are partners with KMSS and for many years have worked on a large number of medical residents and health professionals. KMSS is one of the largest independent accounting firms in Alberta and is focused on owner-managed entrepreneurial businesses and their business journey. I would like to give a special thanks to Connie Ellis for the opportunity to speak with all of you today. Connie has for many years been an advocate of giving you knowledge on how tax and tax planning come together once you have completed your residency. We are hoping to give you some of this knowledge tonight. Tonight, we'll be talking about some of the following tax information: tax rates, tax deductions, tax credits, taxation for medical residents, taxation for practicing physicians, taxation for a professional corporation. We will look into the accounting for income and expenses. We will talk to you about the right time to incorporate and building your team of advisors. If you have any questions, please note them on the chat and we will do our best to answer them. An introduction to the world of tax and accounting as it applies to the medical practitioner.
The slides don't appear to be, there we go.
Okay, we good now?
Yeah.
So an introduction to the world of tax and accounting as it applies to you, the medical practitioner. In very broad terms, the vast majority of residents are employees of their hospital. They receive a salary with the required CPP, EI, and tax deductions withheld at source. Once completed residency, you may decide to operate your own medical practice as a sole proprietor or through a corporation. Some of you may remain employees of a hospital, but also earn some proprietorship business income outside of your work at the hospital. The deductibility of expenses varies as an employee versus a sole proprietor or a corporation. Jolene, now over to you. Oh, I can't hear you, Jolene, you're muted.
Thank you. Seems to be a common thing these days with all these virtual meetings. It's either mute or unmute or and such. So I'm sure you guys are experiencing this with some virtual classes and stuff as well. So I thought I would start here today. If you just want to move the next slide, Laura.
Yep.
That'd be great. Start talking a little bit about the 2020 personal tax rates. Since we're going to be talking a lot about tax, it'd be good to understand what those rates are for Alberta residents. The top rates are based on, the tax rates in Canada and provincial are based on brackets for different income levels. And so this slide demonstrates the brackets along the bottom of the graph with the corresponding tax rates for each bracket above. So, and you can see that as you move into higher brackets, the tax rate increases. And you can see at the highest tax bracket, you're at the 48% there. And starting up on the left side of the graph, you can see that someone can earn up to $13,000 and they won't pay any tax. And say, for example, somebody who makes $100,000 of salary income, they're going to pay taxes at different rates. So their income between $13,000 and $20,000 will be taxed at 15%. Their tax between $20,000 and $48,000 is going to be taxed at 25%, and the remaining will be taxed at 30.5%. So that's sort of how the tax brackets work. And the highest tax bracket is for somebody who makes up to $314,000. And so every dollar that they earn in excess of that amount will be taxed at that high 48%. But not all of their income is taxed at that 48%. So Laura, if you want to move to the next slide, and we'll see what their actual effective tax rate is and the taxes they're going to pay at each of those income levels. So for example, if you're somebody who's making $63,000, your accumulated tax on that is going to be $12,720, most of which, if you're a medical resident and you're earning salary, that's all going to be deducted for you off your paycheck. And so the effective tax rate on that is 20%. Whereas if you're somebody who's making $400,000, so on the far right hand side, your accumulated tax on that 400,000 is going to be 158,000. And the effective tax rate is 39%. So while you're in that highest tax bracket, you're not paying 48% on all of that income. You really need to look at the different brackets, and that's sort of your effective tax rate is the 39%. On to the next slide. So the next things to understand about tax is what tax deductions and credits may be available to you in order to reduce your overall taxes owing, or alternatively, increase your tax refund that you might get when you file your tax return. So so there's two different types. There's tax deductions, which is a reduction of your taxable income, or as one might call, a write-off. Deductions are deducted from your salary in order to determine your taxable income. Versus, there's also tax credits available. Those are reduction of your taxes that are owing. And so you take your qualifying tax rate and you multiply it by your applicable rate, which federal is 15%. And then that number is applied to reduce your taxes owing. So some of the most common tax deductions that you may be able to take advantage of to reduce your income are, so we've got your RRSPs, and most of you guys are probably familiar with some of this already. So RRSPs, you've got employment expenses that we'll talk about a little bit later, moving expenses, union and professional dues, some childcare expenses, versus tax credits would be tuition. And for tuition, if you refer back to my previous slide, if you had, for example, 16,000 of tuition fees, then you would, in order to determine what your tax credit would be, it would be the 16,500 times the 15% would give you a tuition tax credit of 2,475. Sorry, Laura. Yeah, there you go. So that's tuition tax credits, which I would expect most of you probably might be familiar with or have utilized those credits when you've done your tax return. Other tax credits are interest on government student loans, donations, medical receipts, expenses, as well as maybe the first-time home buyer's credit. Okay, and so examples of some eligible medical tuition tax credits that you guys would be familiar with. So ones that are eligible are your Medical Council of Canada exams, your FRCPC exam costs, or your CFPC exam costs. Ones that aren't eligible would be your US medical license costs, medical library and equipment, travel costs for maybe attending interviews, and your CARMS registration fees. One thing to note that's a change that for 2020 is that the tuition tax credit is just a federal tax credit now, because Alberta eliminated it for 2020. But if you did have Alberta tax credits from previous years that you haven't used yet, those credits still can be applied and carried forward to reduce your income in 2020 or in future years. Okay, so now that we have covered the tax rates and the tax deductions, let's talk a little bit about taxation for medical residents. So who is earning employment income, as well as common types of employment expenses. So Your income typically is going to be your employment income, which is included nicely on a T4 slip that's issued to you at the end of February. Your employment income will have income taxes, CPP, EI already withheld from your paycheck. Then there's also, you may have scholarships or fellowships that typically would be included on a T4A slip. Employment expenses that can be deducted from that income would be limited to limited to what your employer says are necessary to as part of your job. And that would be, an employer would provide you with a T2200 form that says you're required to incur these expenses and you haven't been reimbursed for them. Examples of such expenses include CPSA dues, cell phone costs, vehicle expenses, which I'll talk a little bit more about, moving expenses. And in order to deduct these from your tax return, you do need to keep the receipts to support the expenses and allow for the deduction.
Maybe to add on to that, electronic supporting documents are great, so we don't have to worry about printing things out. If you'd like to scan them or save them in a folder, that's perfect.
Great, thanks, Laura. And there's lots of different apps out there too that you can save your information and receipts on the cloud as well. And so your personal tax payments, so if you have any amounts owing, those would be due April 30th along with your tax return. And so that for 2020, that deadline is April 30th, 2021, unless the government extends the deadline like they did last year. We haven't heard anything so far, so let's assume that the deadline is April 30th. So let's talk a little bit more about some of the common employment expenses, which are vehicle and travel expenses, and what types of things you can include. So kilometers. So you can track your business and personal kilometers using a mileage log. You can claim kilometers driven outside your primary or regular work location for which you didn't receive reimbursement for. So for example, if your regular place of work is the hospital or a clinic, anytime that you have to go somewhere different to a different clinic or a different hospital, that would be kilometers you could track to get employment expense deducted from your tax return. So you want to track your automobile expenses, so your gas, your repairs and maintenance, insurance, license and registration. And then you take those total costs, and when I say you, I mean your accountant, and allocate that. So prorated based on the kilometers driven. So if you drove 20,000 kilometers in 2020, 5,000 kilometers were for business purposes, then we would take 25% basically of those automobile expenses. I'm not sure if anybody's driven 20,000 kilometers in 2020. I know I certainly haven't been driving too much this year, but so as a medical student, maybe you're part of essential services, so a little bit maybe more driving than myself as an example. And then if you have a corporation, you don't necessarily have to track the expenses anymore, and you can just track the kilometers and apply a set kilometer rate that CRA prescribes for us. And also, if you have a corporation and the vehicle is owned by the then there'd be a taxable benefit for basically the personal use of that vehicle. Okay, just a special note there is that, driving from home to your regular work location is considered personal use of your vehicle and not business.
So just one additional comment is Revenue Canada is very much a stickler when it comes to mileage logs. They really do want you to track your mileage as opposed to estimating it. So just something to keep in mind.
So the next expense is moving expenses. So these can be deducted, and some people forget about these. So it is certainly something that we work with our clients on to make sure that, you know, if they have moved or there's been a change of address, that this would be certainly something that we would ask for. So moving expenses can be deducted against income earned at a new location when the following apply. So residence is moved to earn income in a new location in Canada. Residence is moved at least 40 kilometers closer than your former residence to your new place of work, and you ordinarily reside in the home before the move and ordinarily reside in the home after the move. And work is seized from your former location. Laura, I think something came up in the chat there about the slide deck. Is somebody having issues seeing the slides?
Oh, I think they're just asking if it will be made available later.
Yes, it will. So we'll be providing copies of these slides to everybody that participated, and feel free to forward them to some of your peers as well. So no need to be taking notes or anything. Everything will be available for you.
And maybe just to answer one other question, there's a question, should you track your distance from your home or the distance from your primary place of employment? So that depends. If you have a primary place of employment and you're not, and you're going to some outside locations, then you can track it from your home to that other location. It doesn't have to be from that primary place of employment, unless of course you're going there first, then that's where you would track your mileage from.
Great, thanks, Laura. And feel free, you know, to keep with the questions because Laura's going to be monitoring those as we go. So if you have any questions, we'll either interrupt the presentation, answer them then, or answer them at the end. So moving expenses. So eligible moving expenses, what does that include? That includes meals and lodging while you move. So if you keep the receipts, you can claim the meals along the way, as well as mileage expenses, or alternatively, CRA provides a simplified method that's based on prescribed rates and flat allowances per meal and kilometers as well. So transportation and storage costs. So sometimes you have to pay for, you know, a U-Haul truck or packing fees or movers, etc. Or if you've got a time lapse and you need to store some stuff, that would all be included as an eligible moving cost. Temporary board and lodging, lease cancellation costs, as well as sometimes often people forget is if you had to get out of a previous mortgage or you had to sell your other property, costs of selling, so your realtor fees can also be included as eligible moving costs. So that can be a big one. Those realtors, they take high percentages sometimes. So moving expenses can only be deducted in the year of the move or carried forward for 1 year and only against income earned at the new location. So if you're moving because you're going to study and take school somewhere else, that's not necessarily, and if you're not making any income at that new location, you maybe don't have any eligible moving costs because there's no income to deduct it from. And just as a note, moving expenses are often subject to CRA audit. So make sure you have all the backup before you deduct them on your tax return, because CRA is probably going to come knocking on your door asking for those receipts. So you want to be prepared. Next slide. Is there a question there?
So the question is, when we do our 2-month rural rotation, does the drive to and from the rural, or there and back from the rural community, count towards work-related mileage? Or is more moving costs, gas expense? So your rural rotation, if you have assigned T2200 and you can deduct vehicle expenses, then you would be able to deduct that back and forth mileage. But it just depends how the T2200 is completed.
Okay.
Oh, okay. So there's another comment that the rural program gives a stipend check for travel. So that would kind of eliminate that.
Yeah, and that goes for any of these employment expenses. If you're reimbursed from your employer for it, then you can't deduct it as an expense because you're already getting a reimbursement. But if you are getting reimbursed for only a portion of it, there's certainly a deduction that may be available. You take your total expenses less what you reimbursed for, and there might be a balance there. So moving on to medical residents. So sometimes you may earn both employment income as well as business income, which is commonly referred to as moonlighting. So, business income would generally be maybe earned from a locum. And so when you have that circumstance, the expenses that you can deduct are no longer limited to your employer's Form T2200, and the expenses may become a bit broader because you can deduct them from your business expenses. Note that when you do earn this type of income, that it wouldn't be included on a T4 slip, and there won't be any income taxes deducted from it. So it does have to be reported on a statement of business or professional activities statement, and that's included in your T1 personal income tax return. And then you would have taxes that you would have to pay when your tax return is due. Okay, and so moving on to sort of the next step, so taxation for a practicing physician. So you're no longer an employee anymore. So your income that you get that gets deposited in your account is what we would call your gross income. It's not on a T4 slip, and there's no income taxes withheld. So you're going to be responsible to save for the income taxes as well as your CPP employer and employee portion. So take, for example, you're a practicing physician and you're making $60,000. If we go back to our slide where we had how much taxes somebody would owe on $60,000, you're looking at about $12,000. And so you've got, when you file your tax return at the end, you'd have to pay that amount of taxes in addition to CPP. And for 2020, that is looking at approximately an additional $5,000. So if you make $60,000 of not employment income, so no taxes being deducted, you can kind of expect that when it comes time to filing your tax return, you know, you should put away about $20,000 for that. So, and that's 60,000 on a net basis, just so you know. That would be after you apply your deduction. So let's talk about what deductions can be applied against that income that you earn. So these are called business expenses versus employment expenses that we talked about earlier. So the range opens up, and things such as home office, convention expenses, limited to 2 per year, advertising and promotion, which is restricted to 50%. There's accounting and legal fees, professional development, office supplies, repairs and maintenance of office equipment, or other expenses such as insurance, malpractice, office, maybe some overhead, interest on business loans and bank charges, and professional library and equipment. If you remember before, we talked about that wasn't eligible as a medical student. Now it is, and it can be deducted as a business expense once you're self-employed. So your income and expenses are reported on the statement of business and professional activities, which is included in your personal tax return. And your taxes are due April 30th, while CRA does give you a little bit of an extension on your tax return filing deadline, which would be June 15th. But typically we would recommend that we're doing them before April 30th because you need to know your tax balance is owing April 30th. So in order to calculate what you owe, you sort of need to prepare the return. Laura, do you have any comments to add on that?
No, we do have one more question though. You have to be incorporated to make business deductions. And no, you don't have to be incorporated. You have to have a proprietorship though, which is your business income on your business statement that you include in your personal tax return. So as long as it's not only T4 income that you have business income outside of your T4, then you can have business deductions.
Great. So moving on to the next slide, which we're going to talk about business expenses. So that's a great question leading into that. So back one slide.
Oh, did I get ahead of myself?
Yeah, business expenses. So what is a business expense? So generally CRA defines it as incurred for the purpose of earning income, and it must be a reasonable amount. So all those examples that I provided were all examples of what business expenses would include. What it wouldn't include is personal or living expenses, or capital expenditures, or those that are specifically disallowed for tax purposes, such as life insurance premiums, 50% of meals and entertainment, golf club dues and fitness dues, and expenses with a personal use component should always require special attention. So if you're using something for 50% business purposes and 50% personal, you should be allocating that proration to that business expense. So moving on now to, we talked about the taxation for a medical resident and a practicing physician. Now we're going to talk about the taxation for a professional corporation. So your business expenses are now corporate expenses. And sometimes there's a myth that when you incorporate, there's the ability to deduct more expenses. That's not necessarily true. The business expenses are the same for a professional corporation as they would be from a practicing physician out of your personal income tax as a sole proprietorship. Okay, the one additional expense that you're going to have in a professional corporation is now salaries paid to yourself. And so corporate taxation, the way it works is the corporation is going to pay 11% on taxable professional income. So that's your income less your expenses earned below the 500,000 small business limit. And if your income exceeds the 500,000, then the corporation is going to pay 23% on that income earned in excess of that. The company is responsible for withholding taxes and CPP on the salaries paid to yourself, as well as if you have any other employees. Additional funds can be drawn out of the company to the shareholders in the form of dividends, and dividends are taxed personally at lower rates than salaries. And that's because your corporation has already paid tax on that income. So it's after tax dollars when you take out a dividend of your professional corporation. So the way that the tax system works is we call it fully integrated. So the combined corporate and personal tax rate at the highest, remember that highest bracket, so income personally earned over the 315,000 is 48%, whether you earn it in a corporation and distribute it out to yourself, or whether you just earn it individually. However, if you don't pull all the money out of the company, there is a tax deferral advantage, which is really 37% at the highest tax bracket, because if you earn it all personally, you're paying 48%. But if you leave it behind in your corporation, you're only going to be taxed at the corporate rate, which is 11%. So that's a 37% differential. Income and expenses of a professional corporation are reported on an income statement on the T2 corporate income tax return. The taxes are due 2 or 3 months after the year end, and the tax return is due to be filed 6 months after the year end. The year end of the corporation doesn't necessarily need to be a calendar year. So we have a lot of clients that have corporate year ends of September as an example. And that allows for additional tax planning opportunities when it is not in alignment with a calendar year. And that would be something that you would discuss with your accountant when you incorporate as to what year end month would be best for you. So moving on to the next chart. So here I've demonstrated an example of taxation of professional corporations. So the first scenario, you're earning professional, so your billings are coming in, maybe from Alberta Health Services or whichever, and say you earn 160,000 and you pay a salary. Maybe for the purposes of this example, we're going to assume that you want to pay salary to yourself of 150,000. Doesn't matter what your top line is. You want to maximize your RRSP, and you need 150,000 gross in order to pay your mortgage and etc. So you have a salary of 150, so that's a deduction, a corporate expense, and then you have some office and business expenses of 10,000. So in scenario one, you end up having no corporate taxable income because your expenses equal your revenues coming in. So you don't pay any corporate taxes, but you do have to pay some taxes on the salary that you paid to yourself. So your corporation is going to withhold that and provide a T4 to you. And those approximate taxes there is going to be 42,000 you're going to pay on that $150,000 salary. So in this example, your effective tax rate is 28% and you're going to pay $42,000 of taxes. In scenario two, you maybe get a little bit more established in your career and you're earning 300,000 and your expenses are still the same. And so your corporate income is 140,000. So you're going to pay 11% tax on that, which is going to be 15,000. So your net income after tax, which is available for distribution, is 124,000. You're going to, as far as tax goes, you're going to pay the same personal taxes on your 150 salary of 42,000. And if you decide to distribute the 124,000 from your corporation to yourself in the form of a dividend, you're going to pay $48,000 on that. And so your total taxes, personal and corporate combined, is going to be 106,000, assuming that you fully flow out all the money out to yourself. And that effective tax rate is 36%. However, if you decide if you only need the 150,000 salary, you could choose to not distribute the 124,000 from your corporation out to yourself and leave it back in your corporation to accumulate. And if you do that, you're going to save $48,000 of taxes that year. And that is the benefit of having a corporation, is the ability to defer taxes. And it's just a deferral because eventually when you take that money out of the company, you're going to have to pay taxes on it. Scenario 3, I'm not going to run through it completely, but you can see your effective combined tax rate on that is 41%. So, and the tax deferral advantage is 123,000. So the more money you're earning and the more money you're able to leave behind in your corporation, the higher the tax deferral advantage is, because you're paying that, the difference where I said there's a 37% tax deferral advantage, your corporation's paying 11 versus what you would otherwise pay at the 48% at the highest bracket. Okay. Next slide.
Oh, I'm on the wrong.
So tax planning opportunities. So just a few here. So maximizing deductible expenses is certainly, you know, as a medical resident, that's kind of what you're sort of looking at. Maximizing tax credits, looking at whether it makes sense to contribute to your RRSP, and know that each year when you accumulate your contribution room, that carries forward indefinitely. So if you're not contributing to your RRSP this year or previous years, you don't lose that room. So you can carry it forward and maybe contribute into your RRSP when you are earning higher income, and the advantage may be bigger for you because you might be in a higher tax bracket then. So utilization of accounts such as TFSA and RESPs. So while those aren't a deduction from your taxes, the money that's in there gets to accumulate and earn investment income tax-free. There's also tax deferral benefits to take advantage of. That's such use of using a corporation, and then some estate planning items as well.
Okay, so maybe we'll just stop for another question here. The question is, can you please explain why I would give myself salary and dividends instead of just a larger salary? So for the most part, what we want you to do is have a salary that represents what your expenses are each month. And that way your salary, you're living off your salary and you've already made your income tax withholdings to Revenue Canada as part of that salary payment. If you want to take dividends, dividends are there as a way to, maybe if you go on a holiday and you need $20,000, you can pull that out of your corporation all at once. At one point in history, it used to be tax beneficial to pay dividends instead of salary. That's not the case anymore. Salary and dividends, once they're fully integrated and consider the tax you pay in the corporation, they're taxed very similarly. So there is no reason you could just pay yourself an extra bonus as opposed to paying dividends. There's no right or wrong answer. It just depends what works best for you. So hopefully that answers your question.
And just one thing to add, I guess one reason why you might do dividends is you don't have that direct liability to pay withholdings to CRA if you take out salary. So, and it does allow for late planning opportunities as well. So, you know, if December's already hit and you forgot to do remittances on money that's kind of taken out, you can make them a dividend because the deadline for dividends is the end of February. So, so next, so GST, I'll probably just skip over this, but I think, you know, for the high level picture is that medical services are exempt from GST, and GST that you pay on expenses isn't recoverable. So no need to rush out and register for a GST number. So accounting for income and expenses, just important of setting up good habits at the beginning. So keep proper books and records, separate your bank statements and credit cards from your personal bank accounts and credit cards. It's just going to make life a lot easier and easier to track. All business revenues that you earn should be deposited into a business bank account, and just organization and retention of receipts. So develop a system that works for you. There's lots of different apps and software programs available to assist. So QBO and Xero are both cloud-based accounting solutions that you can access from anywhere, including your phone. And so those work really well. You can link that up with your bank account so that it automatically updates for activity that's going in and out of your bank account. Programs that you can use to track and retain receipts, you can use QBO for that purpose as well, to snap pictures of your receipts. There's also other programs like Receipt Bank and Expensify that are all available on the App Store, as well as lots of different mileage trackers you can use that will help you keep logs. Spreadsheets can work for unincorporated businesses, but not recommended for growth-oriented incorporated businesses.
Okay, and there's one more question here. Can dividends be transferred to family members or other members of the corporation? So I'm sure you've heard lots of talk about tax on split income. So you can have your spouse as a shareholder in your corporation, but unfortunately, until you turn 65, if you pay him dividends before that, they are taxed at the highest rate, no matter what margin he's in for tax purposes. So once you turn 65, then you can pay a spouse dividends from your PC. But before then, it just doesn't make any sense.
Okay, next slide. So after residency, I think there's been lots of questions about, should I continue on? Should I do a sole proprietorship or a professional corporation? So I'm going to talk a little bit about what a professional corporation is and what factors you need to look at when you're deciding whether to incorporate. So a professional corporation is a separate legal entity. The revenues belong to the corporation and expenses are paid by the corporation. The professional is a shareholder and owns the shares of the corporation. And as Laura mentioned, there is an ability for a spouse to own non-voting shares. However, income splitting is limited due to the tax on split income rules. Annual compliance is required when you have a professional corporation. That will include, filing an annual return. That can be done at Alberta registries, or your lawyer would be doing that. A T2 corporate tax return needs to be prepared that generally an accountant would assist with, as well as T4 slips for the salaries that would be paid out to you, and T5 slips for any dividends that are declared out to you that your accountant would also help with. There's also costs associated with incorporation that would include legal fees for the initial corporation, and who's going to do the record keeping? Is it you? What's your time worth? Or do you have a bookkeeper, etc.? There's also annual legal and accounting fees for your financial statements on an annual basis. Next slide. So when to incorporate is always the question that people come and ask me. So there's lots of factors to consider, and just because incorporation might be a good decision for your peer, it may not be the best decision for you, and it really depends on an individual scenario, the stage of life that you're in, and what your personal and family spending requirements are. So in year 1 to 5, you know, you're kind of a new practitioner, single maybe you've got student loans, lots of debt. But somebody who's maybe in year 5 to 15, more established, maybe they're married, paid off all their student loans, house mortgage, young children, and then you've got your senior practitioner with no debts, children maybe going to university. So those are just some scenarios, but each, depending on what stage you are, will depend on whether incorporation is a good decision for you. So if you could just move to the next slide, please. So when to incorporate? Again, if you're a new practitioner, sole proprietorship may be preferable. As we discussed previously, you don't need to incorporate to be able to have access for business expense deductions. You can have those same deductions as a sole proprietorship. It's probably preferable because if you're not required to, because if you have to extract all the money from your corporation anyways to pay off student loans, pay for weddings or whatever you might need to pay for, there's no real significant advantages of having a corporation, and the ability to deduct expenses is consistent. So if you remember from my chart where I did scenario 1, 2, 3, scenario 1 in that corporation wasn't paying any corporate taxes and they weren't getting any deferral advantage because they were taking out everything from the corporation. And so the only thing you're out is the additional accounting fees and compliance fees for having that corporation. But if on the other hand, you're an established practitioner, or alternatively, if you maybe have a spouse who's making a lot of money, or you inherited money and you don't have high spending requirements, you know, maybe you don't need to take out all the money of your corporation. So incorporation then would be recommended once you have excess cash available. You've paid off all your student loans and you're working towards paying down some of your mortgage. So the tax deferral benefit as a result of leaving income in the corporation because it's taxed at the low corporate tax rates versus personal tax rates. And again, just best to seek professional advice from your accountant when you're looking at the decision to incorporate. We have had scenarios better to look before than after, where we have people that have come to us, they've incorporated, they're pulling everything out. And, you know, once you kind of incorporate, it's hard to go backwards. So best to get the advice ahead of time.
Okay, so now we're kind of nearing the end of the session. So what we'd like kind of, you know, just recap the top recommendations we have for you. Discuss the appropriate strategy with your client. What is the right strategy? What is, you know, whether you're a proprietorship, whether you're going to incorporate, it all depends on your unique circumstances. What is the right remuneration plan for you and your spouse? Part of that is if you have excess money and you can leave some of your money behind in a PC and get that deferral, that's great. The other thing is you bring your spouse in as a shareholder. You may not be able to pay her dividends or him dividends now. But once you retire, that's a great income splitting opportunity, because then you can pay them dividends and it's not limited. So that's just planning for the future. And monitoring what you're currently doing, because as the years go by, circumstances change, and we want to be able to adapt your tax plan to your changes in circumstances. Number 2, keep good records. Whether it's computerized, if you're capable of doing them yourself, or whether you're too busy or you don't have an interest, then finding someone who can help you. Letting your accountant get involved and help you out. And if it relieves stress for you and you can work an extra day, you know what? It's all worth it. And it keeps you doing what you love to do. Understand your affairs. Try and keep things simple. You want to know why you're doing things and understand the plan that you've talked about and what your accountant is recommending. Now, next is building your team of advisors. You may feel that getting to know a group of advisors doesn't seem all that important right now. The issue is that it's hard to predict when you will want to involve an advisor. Usually when you want the advice of an advisor, it's on short notice. If you already have a relationship with someone, then it becomes easy to contact them, discuss your circumstances, and receive information so that you can make an informed decision. It is important that you start to build your team of advisors early in your career, as you just never know when you need to make a decision and you'd like to have some more information before you make it. Do I need an accountant? In our opinion, yes. Similar to is I would need a doctor. You wouldn't want your patients using Google to self-diagnose or asking their friends. You want to have someone that you can rely on and you can trust. Avoid the tax pitfalls. Look after things right away from the beginning. Prospective planning is best. Retroactive planning is never the way to go. Take responsibility for knowing the basics and seek professional advice. Leave the accounting to the professionals so that you are free to do what you do best and grow your practice. So the KMSS fee guide. So I'm sure you're all wondering how expensive it is. What's the cost to have help with your personal tax return or incorporating and the annual costs of a professional corporation. So the introductory meeting is free. It includes a 1-hour individual consultation to understand your tax and accounting needs. For a medical resident, to prepare your personal tax return and your spouse with fewer than 10 slips, closer to the $250 as soon as you include a locum, which results in a proprietorship income and a business income statement, it's closer to $850. A professional corporation, the cost is $4,000 to $4,500, just depending. This would include bookkeeping, financial statements, tax return, T4, T5 slips, a year-end meeting that we can talk about your tax planning and make sure you're maximizing any tax deductions available. And it includes minimum investments and a personal tax return. So in closing, Jolene and I would like to thank each of you for your attention throughout our presentation. We hope you found it and the slides informative and valuable. Our contact information is included on the screen and the slides will be made available to you shortly. We would welcome the opportunity to answer any questions and provide a free 1-hour consultation to understand your tax and accounting needs. Please do not hesitate to reach out to our assistant, Daniela, to book your introductory meeting. Her contact information will follow in a separate email with a copy of the slides. Thank you again for joining us tonight and have a great evening.
If anybody has some specific questions and they want to turn their video on, go ahead. We'd love to see you.
Okay, I think we're good. And I will sign off.
Great. Laura, I'll come to your office there. Because
Sure,
I want
sounds-
to save the chats maybe.